Coming up today, Tesla earnings fall sharply as Elon goes all in on robo-taxis. Will it pay off or turn into a flop? I'll tell you what I think fair value on Tesla is and what could happen next. A look at some other earnings. Has the stock market pullback finished or is there further to go? The latest warning from Russia to the West and some more swing trade ideas. Hey, what's up guys? Welcome back, and we just got Tesla earnings, as I'm sure you've all heard, even though numbers came in a lot lower than expected. Like I said yesterday, the market had already been pricing that in, especially since we were down almost 42% year to date just before we got earnings. And you can see just going down to a 5-minute chart after hours, we popped straight up after we got the report. Currently up 10.8%, trading around $160 a share. And just to give you some highlights of what the earnings report contained. First quarter revenue of $21 billion, down 9% year over year. It came in a lot lower than street estimates of $22.15 billion. And the bulk of that miss came from auto sales, down 13% year over year. It's actually services and other revenue, and things like solar and energy, actually still growing 25% year over year. Company said revenue was impacted by lower average selling prices and lower vehicle deliveries in the quarter. Earnings per share, 45 cents, a lot lower than consensus of 51 cents. And we have quite a big gap for the first time in production and deliveries. They only delivered 386,000 EVs in the first quarter and actually produced 433,000. And that's why they've been cutting prices. They've got a bit of a inventory glut happening for the first time in quite a while. Normally, they've had a supply problem. Now they've got a little bit of a demand problem. As the EV industry around the world's a bit soft, buyers pulling back, higher interest rates are biting, not to mention a glut of cheap EVs coming out of China, and why they've pivoted a bit more towards robo-taxis and accelerating that and placing the focus on that to try and get away from a cheap EV where they may already be beat by China. And in not a good sign, they're undergoing cost cutting, trimming staff left, right and center. That's not a sign of a strong growing company. Typically, when companies are in growth mode, they're accelerating hiring and looking to spend more money. Tesla's currently doing the opposite, so they're looking to shrink their business here in response to the market. They also said global EV sales continue to be under pressure as many car makers prioritize hybrids over EVs. They said for 2024 that their vehicle volume growth rate will be notably lower than the growth rate achieved in 23, and they've updated their future vehicle lineup to accelerate the launch of new models ahead of previously communicated start of production. And they're currently working on ride-hailing functionality that will be available in the future. So the pressure's really been on Elon and his team this year, with Tesla's stock price coming off hard. The resale price of Tesla's been cut in half. They've lost a couple of key executives. There's controversy and issues with his compensation package, relocating headquarters from Delaware to Texas, and now they've actually got negative growth rates, which for a high-valued company like Tesla can have a magnified effect on the stock price like it has been this year. And so to retain that high valuation, he really needs to keep investors excited about the future, because there's no growth right now, but investors need to be convinced that there's growth just around the corner in the next year or two so they can continue to bid up shares. And Elon's really going all in on robo-taxis. That's self-driving EVs that owners can then add to the robo-taxi network. The Tesla leaves your house, goes and picks up people and drops them all around town, and you get a share in that revenue. Pretty ambitious, but like Elon says himself just a week ago on X, that he's not quite betting the company, but going balls to the wall for autonomy is a blindingly obvious move. Everything else is like variations on a horse carriage. So some say that's plunged the company into chaos right now. And I guess like most things, you could look at it from two different angles. There's high risk, high reward. So if he can pull it off, he'll be the first company there to do it and get to enjoy the spoils of first mover advantage. However, like anything with big rewards, it comes with big risk. And if he doesn't pull it off, that could hammer the company numbers and stock price further into the ground. With some saying Tesla's already in its flop era, as sales are falling, stocks dropping, and starting to lose support from some die-hard believers. However, for any growth company, it's never smooth sailing every year. It's not always linear growth. Sometimes it is 2 steps forward, 1 step back. But this is really a critical time now for Elon and his team to turn around the business and at least keep investors excited about what's around the corner. And so the stock's clearly in a downtrend, even though we're getting a bit of a pop here, maybe a bit of a dead cat bounce around 160. It's still lower than where we were trading just a week and a half ago. My stock fair value indicator currently has it at $113 a share. And like I said, some people may add a premium onto that for robo-taxi's potential. Others may wish to apply a discount because of the risk. It's also now got negative shareholder yield. This indicator of mine gives you a modern day look at what the company returns to shareholders in the terms of dividends, buying back stock, and reducing debt expressed as a percentage of market cap. And so typically companies with negative shareholder yield have a bit of a headwind, as you could kind of think of it as shareholders having to put money in to keep the company propped up. That is the opposite of returning capital to shareholders. And just looking at a clean monthly chart of Tesla, my stock fair value has got around $113 a share, which I think is about right now. Given the risks it has, its negative growth rates this year, still has a price to earnings of 33, which I think could still be a little rich given its current negative growth, inventory gluts, and a number of key short-term risks. And if we were to get down to 113, 110 a share this year, I would say that would be at fair value, a reasonable valuation, and technically could set up for a big double bottom as well. However, for here and now, we're currently trading around 159, still well below the 50-day VWAP 169. So technically, we're still in a downtrend, even though we're just getting a bit of a short-term dead cat bounce, as it's just been over the last couple of weeks. Stock came off 20%. So the market saw this report coming. It already got ahead of it like it often does. And now there's just a bit of short covering and a bit of a relief rally. And we'll see whether the stock can hold above 160 tomorrow and fill this gap from this big bearish candle down on the 15th, in which it closed at 160.140. And so to sum up, well, it sounds good with some of the things he's come out with today and trying to get the market's attention and focus onto robo-taxis. It may not be enough to actually turn around the stock and put it back into an uptrend above $200 a share, as we've now just got the third consecutive earnings disappointment, beating estimates by 8%. Previous one was 2.8%, and before that 9.4%. And you have to go all the way back to 2019 to find the last time they did 3 earning misses in a row, and it wasn't until they did a big beat and surprised the market and actually came in with its most profitable quarter ever and really went towards a cash flow positive company. That's what set it off on a huge rally on top of all the COVID liquidity. So for now, I'd say at best we're going to consolidate for a little bit. If not, make it down to 110, 120 at some point this year, especially if the market remains under a little bit of pressure as well. Moving on and just having a look at some other big earnings we got out today. Visa came in with some pretty good numbers and still showing growth year over year. Earnings of $2.29 compared to $2.04 a year earlier, and revenue up 10%, showing consumers are still spending near record clips, and the market also liking that result after hours, up 2.5%. Also got earnings from Pepsi, and even though they beat on estimates, the market gave a negative reaction, potentially on the continuing effects of a food safety recall on a range of Quaker products. And there's a look at the market's reaction today, off 3% after it had a nice little run going into it. Also heard from GE Aerospace after they recently just split the company and spun off their Vernova vision into its own listed stock. And stick with me because that stock is one of my new swing trade ideas today. Looking at GE Aerospace, revenue rose 11% and lifted their outlook forecast. And this stock has been on a parabolic rip for quite some time, and the market just loved it again today, up 8.3%, ripping up to new multi-year highs on a momentum thrust signal. The big one tomorrow will be Meta. Make sure you come back for that one. They'll have some big expectations going into that as well. They should beat on consensus estimates, and they're strongly integrating AI across all of their products after spending heaps on NVDA GPUs. And there's a look at the stock going into earnings tomorrow afternoon, enjoying a nice little bounce after hours as well. And so the S&P 500 just did a 5% pullback off highs, bringing that 5-month parabolic rally to an end. A lot of people wondering now, is that all we're going to see this year? Just a 5% pullback before we march higher into the election? According to researcher Ken Fisher, he says yes, as bear markets don't typically start with a sharp correction. He said while investor sentiment has soured, stocks are still on the upswing, and the latest pullback is but a blip within a larger bull run, and said it doesn't even matter if the Fed cuts interest rates, the bull market can still power on. Not as certain is research out of JP Morgan that says the recent sell-off in stocks is just a start, and the ongoing correction has further to go as risks mount, saying investors are too complacent and inflation and geopolitics could hurt the market. Also citing macro headwinds such as rising treasury yields, a robust US dollar, and heightened oil prices, saying that inflation's too hot, more repricing for what the Fed's going to do, and rates staying higher for longer. Even the world's largest wealth fund coming out of Norway, who have for decades dollar cost average their vast oil revenues into global stocks, have said that there's clearly a lot of froth within the technology sector. And even JP Morgan CEO Jamie Dimon is worried the US economy is headed back to the 1970s, saying he thinks there's a chance that can happen again with some of the issues of the 1970s that troubled the economy, like stagflation, which was a combination of low growth and high inflation. With him going on to say, I worried that it looks more like the 70s than we've seen before, saying there's still a number of risks to the resilient US economy that could lead to a stickier inflation and higher rates than markets expect. He's prepared his bank for a wide range of outcomes, with everything from interest rates from 2% to 8% or even more. And here's a look at some stats going back almost 100 years on the S&P 500 index, what the maximum intra-year drawdown is versus the end-of-year total returns. So we've currently had a 5.5% drawdown, and that is really near the low end of the scale, with the two lowest years being 2017 and 1995, where the max drawdown was less than 3%. The average intra-year drawdown we get for the S&P is 13%. However, the thing you got to remember with markets is when we look at average returns, for example, the stock market on average goes up about 8 or 9% a year. Most years are not around that 8 or 9%. You can see here in the total return column. It can vary wildly, with years like up 32%, down 37%, and everything in between. And just looking at economic data, got manufacturing and services PMIs today coming in a little weaker than expected, a bit of a surprise, and thus caused treasury yields just to pull back a little bit after they have been on a hot run lately. However, crude oil found its footing today, finished up a little higher. Market's still a little on edge with what's going on in the Middle East. However, we appear to be consolidating now, even though we got it back above the 50-day, $83 a barrel. Trend strength's gone negative, and I'd say we may range between 88 and 78 for a little while here. Gold could do a little better though, as like this article says here, still a lot of central banks that are accumulating it at record clip, with the biggest being China, as they look to diversify their reserves out of US dollar assets. And there's a look at gold, still holding on to a bit more of a trend than crude oil, just having a bit of a shallow pullback here. And again, we got another strong move up. And wheat futures today on volume here. Corn as well, pushing up to these multi-month highs, while the overall agricultural commodity index continues to hold on to its strong uptrend. And we're still getting some pretty big warnings coming out of Russia after the US, along with its European counterparts, is considering donating the almost $300 billion in frozen Russian assets seized by the West since their invasion of Ukraine 2 years ago, and actually giving them all to Ukraine, and which would be a big material shift of the balance and giving Ukraine a huge injection of funds to keep fighting the Russians for many more years. Understandably, that's upset Putin and his team, and they're threatening retaliation, saying the Europeans know that there will be a very tough response on our part and an adequate response. And they've already prepared some response measures if that were to go through. However, Western officials are not fully decided on it yet, but that could be another source of rising tensions. Nothing's changed in Fed fund futures. Market's still pricing a cut in September. Fear and greed index still in the fear zone. And just like I've been saying the last couple of days, expected a VIX crush here as geopolitics died down. We're looking for the VIX to find footing around high 14, potentially low 14 over the coming days. Nice bounce back in high yield bonds as Bitcoin is consolidating below its 50-day. Another bounce back for Chinese securities, and clean energy bouncing a little bit here too after we had been quite technically oversold. And there's JP Morgan hitting our profit target on open this morning. Previously gave the swing trade idea on the 18th after hours for a reversion to the mean back to the 50-day, and that worked out pretty quickly. Nice 3-day trade there. And the swing trade idea I gave yesterday could be potentially playing out as well on the consumer discretionary fund. Traded up 1.2% today, up further after hours as 11% of the fund is in Tesla. However, its biggest holding is Amazon, but they still report in a week. So we're looking for this to play back to the 50-day VWAP, even though that may be around 176 or so by the time it comes back. And so the market is having a little overall bounce here. However, for anybody concerned that we still may be in a downtrend, and for some short trade ideas, probably the most overbought sector right here is actually utilities, one of the very few sectors above its 50-day VWAP. Currently overbought on my DSI. Trend strength is negative, which means the market's ranging, and we may have stalled out today where we got that big bearish candle back on the 14th of December, and that can quite often make for a good places to enter trades is in the wicks of big reversal candles like this one here. So this too could be potentially a short swing trade setup with at least 1.5% of wiggle room or so, and maybe a bit of a play back down to the VWAP as well by the time it gets there. About a 1.5 risk to reward ratio. Other candidate I'm looking for a short swing trade is GE Vernova, up 8% today after the company was spin off. GE Aerospace had a good earnings result. It too is in the wick of this big reversal candle on relatively low volume. However, this is a bit more risky since we have earnings coming out in a few days. And lastly, for another potential short swing trade setup idea, NVDA. For those of you who watched my weekend special video, I gave you my new technical analysis concept of signal candle, entry candle. And so NVIDIA gave us a big signal candle on Friday, finishing down 10% on volume, momentum downward thrust signal we've pulled back here today on low range, below average volume, within the body of NVIDIA. Potential short trade here. Probably want to give it 6 or 7% of wiggle room, maybe a bit above the 50-day VWAP, then maybe a play back down into the 730s, where would be a little technically oversold, giving us a risk to reward of 1.48. And just moving on to Apple, trying to hold support here in the 160s again. A little bounce up for Microsoft, and Alphabet, Google, still the strongest performing of all of them. And just looking at the S&P 500 itself, as I've been thinking, we could do a little bounce here. However, we still may hold this downtrend ever since we got that big bearish engulfing on the 4th of April. And if we were to use the high of that candle to this recent low, a potential pullback zone could be from 5100 right up to around 5150, I would say, which we may hit tomorrow or the next day. And just looking at the market color, we are definitely bouncing up the front here. And risk on assets. Now actually got volatility yields in gold and the dollar below their 5-day moving average. Pretty much everything else above it, and with half of all sectors above their 20-day as well. So we're definitely having a bit of a bounce here in the markets. However, it's a defensive bounce, like I just showed you, and utilities leading the way up higher. You look at the DSI 8.5, staples 5.7, but then you got the growth sector of technology. Still negative 6.98, semis negative 0.5, and discretionary still negative 7.5. So it's been a bounce led by defensives, which tells me this downtrend could continue, as we've still got short-term bond yields a little bit elevated, still got heightened risk of geopolitics, crude still holding up there as well, and the VIX is still well off those lows we saw last month, down at 12. However, if we were to make a big thrust momentum move past 5150 on the S&P and saw risk-on sectors take the lead as well, with a bit of rotation out of defensives, then we may be just marching back to all-time highs. So I'll be looking whether the market can stall out around 5100, 5130 or so. And if it does, then hopping on board a short and a really hot growth stock like NVIDIA could be a good way to hedge a portfolio. And that's a wrap for today, guys. Thanks very much for tuning in to the daily market review. And make sure you come back to the Click Capital channel tomorrow, where I'll dive into Meta's earnings and let you know everything else out there I'm seeing as well. See you then, guys. Cheers.